Hello and welcome back to the podcast. This episode we are joined by Mr. Steve Larke and Mr. Dave Szybunka for a live edition of the podcast at the 2024 CALEP Conference. Mr. Larke is a corporate director at Topaz Energy, Headwater Exploration, and Vermilion Energy, with previous roles at Azimuth Capital Management, Peters Co, and TD Newcrest. Mr. Larke graduated with a Bachelor of Commerce degree with distinction from the University of Calgary and has also earned the CFA and Institute of Corporate Directors designations. Mr. Dave Szybunka is a Senior Portfolio Manager and Managing Director of the Energy Team at Canoe Financial and has 17 years of experience in portfolio management and energy equities analysis. Mr. Szybunka previously worked at Rain Capital as the head energy portfolio manager, and prior to that was an associate portfolio manager on the Canoe Energy team. Mr. Szybunka earned a Bachelor of Commerce degree in finance from the University of Alberta and is also a CFA charter holder. Among other things, we discuss global energy demand, 50% consumption growth, and how investors can benefit. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This episode is brought to you by Upgrade Labs. Upgrade Labs offers a comprehensive range of cutting-edge performance and recovery services that have been proven to optimize your health in minutes, not hours. Whether it's accelerating muscle mass and bone density or addressing injury and inflammation, start your experience by booking a free cell health analysis at upgradelabs.com/Calgary. This podcast is brought to you by Energy United. Energy United is an organization with a mission to promote practical energy policy across Canada. Energy United is building a community of Canadians that are passionate about Canada's natural gas and oil industry and are willing to take action. Energy United is driving change on issues that matter, all the way from the carbon tax to the emissions cap. Join Energy United to make a difference at energyunited.ca. This podcast episode is brought to you by 8AM Solutions. 8AM Solutions is the modern Canadian-based software for vendor and contractor risk management in the energy sector. 8AM Solutions leverages industry-leading technology at affordable prices to simplify and de-risk your supply chain, ensuring your operations run smoothly and meet legislative due diligence requirements. Visit 8amsolutions.com to learn more. All right. Well, sounds like we're good. Thank you very much, Steve and Dave, for doing this. I really appreciate your time.
Good to see you, Trevor. Appreciate it.
Also, a quick thank you to Mandy and Dave for organizing this. We really appreciate it. I also just thought I'd start things off with the story about the first time Steve and I did the podcast and how I was 20 minutes late for that occasion. So
as long as you're trying hard, that's what counts.
Things can't get much worse than that today. So hopefully people enjoy it. In terms of the conversation, I thought we could structure it loosely around global energy demand and some of the macro issues affecting the all-time high of energy and the implications of that getting into investing and whatnot. If that works for you guys.
Sounds great.
Yep, sounds great.
And then open it up to Q&A for the audience. So to start off, maybe with Steve, the question of macro and why energy consumption is still growing, and why demand for all energy continues to rise at an all-time rate. What does that mean for investors? And maybe we'll start there.
Yeah, okay. Well, look, first, thanks to everyone and for attending, and thanks to Trevor and Mandy and Dave Balderson. It's absolutely I used to work on a trading desk, so this is terrifying being live because I tend to drop F-bombs all the time, and Trevor's good enough to edit them out. We also did get asked before this started if we could make fun of Marty Staples and what the cost would be. And I mean, it's such an easy target that we said no price. In truth, he's been a great guy to work with over the years, and it's been a lot of fun working with Topaz. But to get to the question, there's a couple ways you can phrase this. And I think there's simple category killer type numbers when you think about energy demand globally, right? And so if you look at fossil fuel demand since 2000, it's up 3.4 times the increase in renewables. And so what that means is that renewables, they haven't yet met the growth in energy demand. And so one of the thoughts I wanted to leave you guys with today is what transition, like what are you talking about? I don't understand the word because I don't see it in the math, right? And I'll give you an illustration. So wood use in 2022 using the UN data, it's at an all-time high. Half of it's used for fuel. So who knew? Like if you don't really go look for that information, and you would have thought maybe we transitioned away from wood as a fuel. And so all we're doing is changing the energy mix, but we keep using more. And I can talk about this stuff for days. Okay. So I won't. However, I thought I'd share with you one fun story. It starts with dynamite and ends with Justin Trudeau, which can you get any better than this? Right. And so a formula that I've sort of devised over the years is energy demand is a function of technology and efficiency. And we keep using more of it. So dynamite, it was invented in 1867. Fast forward, don't worry, I'm not going to go by year. The Trans-Canada Highway using dynamite was built and completed in 1970. It took them 20 years. But without dynamite, it's not happening. But what does that do? Well, it opened up the mining space. And this was going on all over the world, this kind of infrastructure build out using dynamite, opening mines. Coincidentally, you have computer chips coming up the pipe. And okay, let's fast forward 2007, the smartphone that every one of us has in their pocket today comes to fruition, and it's got all the rare earth materials in it that were mined going back using dynamite. Fast forward to 2023, the summer of, Justin Trudeau, using one of these cell phones, tweets and invites Taylor Swift to come to Toronto. And she's the real deal. So everyone goes to see her instead of her doing the normal thing, which is, travel around the country with her entourage. Last week, the Globe and Mail put out that 500,000 people were traveling to Toronto for this concert. And, you think about that, like I haven't seen any data on this yet, but it wouldn't surprise me that Justin Trudeau caused using technology and efficiency, because don't forget that airplanes efficiency goes up about 1.9% every year. Like since 1980, right? It's amazing how good they are. So now you have efficiency, you have technology, and I bet you last week was an all-time high for Canadian jet fuel demand. And the best, most delicious part of this is he did this the same month. You can't get more ironic than this. The same month that they put a cap on CO2 emissions and production. Like you can't make this stuff up, right? But it's very illustrative of my little formula. So anyway, like I said, I can talk about this for days, so I will stop talking. And
so, yeah, I can pipe in there too. Before I do want to thank Trevor for organizing this, but I did work with Steve Larke at Peters Co. This is a big mentor of mine. I talk to the guy 2-3 days a week. He's the smartest guy I deal with in oil and gas. And it's great to learn from guys like that as I started my career at Peters Co. But unlike Steve, I have to do a lot of presentations and I like talking to a lot of people, but it's really good to talk to the boots on the ground people. I'm normally presenting to investors, people investing capital. I make it just sound like we're buying and selling stocks. Well, you guys are the people running these companies. So it's a lot harder than that. To energy consumption, to Steve's point, let's just talk about some facts. When we actually just look at the global energy consumption is up 50% since the year 2000. This is a staggering amount of energy. And when you look at places like China has 4x their energy consumption since the year 2000. 4 times as much energy in 24 years. So these are staggering amounts of energy. The world keeps using it all. And when we look at the world today, the world consumes 300 million barrels a day of energy equivalent. That's a lot of energy, right? You look at the last 20 years, we have been increasing our energy consumption over the last 20 years on average by 5 million barrels a day of energy equivalent each and every year. We think we're inflecting to 6 to 9 million barrels a day of energy equivalent. Population growth, developing world, developed world. So there's 7 billion people in the developing world versus 1 billion people in the developed. So this is all coming in a mixture. We're all acting like we're moving off of one stuff, moving on to the next. I would just say on our stance at Canoe, we look at it all. We think you should invest in it all. Quit putting hydrocarbons against alternative energy. We need everything. We actually physically can't keep up. In the last decade, we've spent trillions of dollars on alternative energy. And we've gone from having 82% of our energy needs filled by hydrocarbons to 81%. We can't keep up. We keep consuming more, and the physical use of these commodities and alternative energy, we're going to need everything. So I would just say I spent a lot of time talking to investors traveling across the country, and I find that in the market today, commodities have not been the place to be the last 10, 15 years. Capital's going to other places, and people are chasing themes. AI becomes a theme. I want to put more capital towards that. You see this capital investment happening in these other sectors. Well, we have a theme in energy right in front of our faces today. It's called the globe keeps using more energy, and no one wants to invest in it. We all talk more bullish energy, but you're not positioned more bullish energy. And that, for me as a portfolio manager, is very relevant. And we'll get into a bunch of that stuff, but putting all of this together, the world is using more and more of this stuff, but no one wants to invest in it. Trust me, over time, the commodity cycle will play out. These stocks will be way up, and the portfolio managers will all say that are running all this capital across the globe, well, shouldn't we invest in more energy because we keep using more and more of it each and every day? I'm telling you, it's happening right here, right now in front of our faces.
We've talked about it before on the podcast, Steve, but what is Jevons paradox, and how does that apply to the rising energy demand in the globe?
Yeah, like so it's illustrative of that formula that I gave you that doesn't necessarily make mathematical sense, but it seems to happen. And that's just, Jevons is a guy back in the 1800s who noticed that the more coal was available, and instead of collapsing the prices and ruining various different industries, he noticed that people invented new ways to use it as it became more cost effective, and such that the demand kept rising. And of course you have, the advent of steam trains and things like that. And the more you used, the more you built out, and it just kept going. And, I have yet to find a technology that has increased efficiency that has not caused demand to lift. And like one day, I think LED lights will get there, but now you have LED lights on everything, everywhere, and they're on all the time. And a lot of people still don't have them. So I feel like that's the only one I can really see that might get there one day, but all the others just keep moving forward. So yeah, it's pretty remarkable. Is that a fair answer?
In simple terms, the better technology gets, the more energy you use, if I'm correct.
Yeah, and efficiency tends to bring the cost down. And we're humans, so we're incredibly inventive, and we're really big beavers, right? Like we never stop building stuff.
Mm-hmm. Long story short, oil demand's at a record high, along with every other energy source. However, that doesn't mean all investment returns work out the same. So the question might be, how do you separate positive sector tailwinds from individual stock selection when certain investments you make may not be the best ones? How do you think about that? Maybe we'll start with Dave.
This is a great Dave question.
Yeah. I'll take a stab at that. So look, I would just say when I talk to investors, everyone wants to talk about oil. Where's oil going? What's the price of oil? Oil. Well, I just outlaid to you that we use more than just oil. We use energy. Our funds are energy. At Canoe, we are energy. And so when we look at making investments, it's not just about oil. These cycles all happen within the specific commodities. The energy is the big theme, but we do keep using more oil, to your point, Trevor, across the globe. We can separate things into the developed world, developing world. The developed world uses 13 barrels per person per year, right? Developing world uses 3 barrels per person per year. Well, I can lay that out in a pretty constructive oil demand outlook as 7 billion people start using more and more oil. But to Trevor's point, we think that this will all play out over time. I always say to our investors, what ends a commodity cycle is a capital spending cycle. Until you start to see signs of aggressive capital spending where investors are calling on saying, let's go, there's not enough of the commodity, we should be investing more. That is the start of the end. Well, we're not in that today. Right? When I look at the oil market specifically to Canoe on the year, we've been the most underweight oil we've been in 5+ years. We've been super underweight this commodity. It's been a little choppy. It's been up. It's been down. We look at the spare capacity within the market. We look at Chinese demand numbers that have been kind of lower than we wanted on the year. Look at the stats. Look at the data. We think there is a crossroads coming. We are handing back more control to OPEC over time. People forget why was the Strategic Petroleum Reserve created? It was created in the 70s because there was massive geopolitical risk globally in the 70s. Saudi shut off oil to the rest of the developed world. The U.S. administration said, we need to never have this happen again. There's 2+ mile lines of gas stations for our people. And what are we doing now? We're drawing down the Strategic Petroleum Reserve. We're at the lowest levels on the Strategic Petroleum Reserve since the early 80s. We're handing more control back to OPEC over time. There's massive oligopolies forming, mergers, acquisitions, all this happening. But I'm giving you all this as a backdrop because this will all change over time. But in the here and now, there has been quite a bit of excess oil in the market. So to answer your question is, maybe I should invest in other areas of energy. Maybe I should not be fully all in on oil. I've been watching the last 12, 18 months, money's leaving energy in a massive way in the capital markets. It's chasing tech. It's chasing bonds. It's chasing to other sectors. Money has been leaving energy. Well, if money's leaving energy and you're in a bit of a volatile, murky oil backdrop, does that really feel like a time that all these oil intermediate multiples are going to expand and valuations are going to go up? No. There's a massive differentiation going on in the market. You're seeing certain mid-cap oil stocks hit 52-week lows. Capital's leaving. And then there's other names that are hitting 52-week highs. We are in the digestive phase. In 2021, 2022, everything went up. It was easy. We all in this room darted a dartboard and made money on energy stocks. Well, when you're in the digestive phase, which is not the end, you're in the digestive phase, it's harder to make money. You need to be way more pointed in your stock selection. You need to be way more pointed in your subsector selection. These are the things that become super important there's a bigger structural trend here. We are in year 4 of a 15-year commodity cycle. But within that, you should be overweight and underweight certain areas of energy within.
And Dave, how does that, I like to think of things in terms of tactics and strategy, and like when you're picking individual names, how do you go about thinking about that?
That's a good point. I mean, it starts with respect the funds flow, right? So respect the funds flow. Where are you at in the cycle? So I kind of hinted at people. We believe we're in year 4 of a 10 to 15 year energy cycle. These energy cycles take 10 to 15 years to go up, 10 to 15 years to go down, 10 to 15 years up. That's how these cycles work. They don't just end after year 4. So when you think through commodity cycles, 2007, 2008, a lot of us were in the energy sector in 2007-8. Calgary's on fire, parties everywhere, people are going crazy, oil's going to 140, everyone's rolling into their broker going like, we need to be buying oil stocks, let's go, we're running out of oil here. Well, when you look in the previous 10 years, that asset class, energy, was compounding at a 10, 11, 12% annualized. You look in the rearview mirror, you made 10+% a year on average. When you look in the rearview mirror, you should not be running to go buy energy stocks. You should be leaving the party. Everyone's yelling that there's not enough energy. You should be selling. Fast forward to the COVID lows. COVID lows, you look in the rearview mirror, commodities and energy as an asset class are compounding at minus 10% annualized. Envision yourself, you made minus 10% every single year for 10 years in a row. Today, when you look in the rearview mirror, energy and commodities as an asset class have compounded at 0% annualized. This is not how an energy commodity cycle ends. It ends with a capital spending cycle. And over time, as the commodity prices go up, consumers go, who did this to me? Government policy does change and investors call on more investment. So today, sorry, I had to get to this point before I had to lay the backdrop, but we're in year 4 of an energy cycle. So when you think about your stocks, at the start of the cycle, you just go buy Schlumberger, Exxon, Chevron, Suncor, big caps. You do not get rewarded for taking risk down cap. So you just go there. Well, now we're in year 4. And when you look at the valuation discrepancies between the large caps, intermediates, and juniors, we are at the largest valuation spread that we've been at since 2001. And what happened in 2001? M&A. M&A was liftoff. Right? Money started rotating in energy into 2003, 2004, and there was big spreads. Well, I think we're setting up for that again, right? We're starting to see more M&A, but when you start going down cap, you got to start being a little bit more careful. We think you're at the time in the cycle that you should start going down a little bit. But a theme that's different today versus prior cycles is decarbonization. This theme is not going away. And we think it's a big part of it's going to take the capital longer to come back. Investors are going to be more reluctant. And because of all of that, you better not wake up and just have a bunch of juniors in your portfolio. They might stay cheap for longer than you think. And that's where we're at in the cycle, where we're year 4, you got to start going down, but this cycle is different than previous cycles. So be careful how far down you go.
Yeah. And I think I'd add a little to that. And by the way, Dave and I are both intense people. So we're working on reducing our own emissions intensity.
That's his reminder for me to say, quit talking so aggressive.
If you think about, as a board member and an investor and a fellow who used to wander around doing research on companies in lots of different ways, you sort of divide it into, and what I encourage guys to do is like you're building something someone else wants to own. And how can you position out of paranoia for times of great weakness? And there's tactical. So a lot of energy companies I find focus on tactics. Tactics are benchmarking and operational excellence and cost reduction and looking over the fence at your neighbor. And those are tactical components, but they're base level. Whereas strategy is something that is a sustainable advantage that you have. And I think talking to the land crowd, right? Creating your own luck through strategy such that you're there when things turn your way. And the easiest way to explain that to you guys, because you guys know all about this, is when you go into an area and you're picking up land somewhere, you want all the zones you can get. And maybe some of them are currently not economic today because the technology isn't there to get anything out of them, but you position your firm for luck, right? And we see it all the time. There's different advances in drilling technology, and shocker of shocks, the good management teams over time end up looking lucky, right? And so how do you position yourself to look lucky? And if you start thinking about companies that way, you can actually dismiss a lot of entities off your screen as investments. You can rent them, right? Short term, this and that. But as things you're going to own for a while, you can make a fairly short list fairly quickly, in my experience anyway.
And what kind of ties to that a little bit is just, if you're in this bigger structural shift that Steve and I are describing, okay, commodities are in 10 to 15 year cycle. We're in year 4. Don't just be all bowled up on the back of that and be like, well, things are going to the moon. I should just own these energy stocks here, or I should just own my own stock. Trying to be counter-cyclical within the structural bull. Let's just play with the last 24 months. Oil went to $90. Look at all the M&A that happened in 2020, 2021. Lots of M&A happened by very smart guys in this city in 2020, 2021 in Calgary. And then as things ripped to $90 a barrel, $8, $9 gas, all the M&A came out again. Everyone started doing M&A. Now it's fashionable to do M&A. All the stocks were up. Now everyone's smart again. Maybe that was the time to hunker down, free cash flow, sit back. Well, now look at the M&A happening in the last 2 months. Smart guys, Murray Edwards, Mike Rose, they're mowing down the city again in the last 2 months. Where were they in those other 2 years? Nowhere. This is smart. Trying to be, and that I give Steve a lot of credit sitting on boards. It's very hard to not get caught up in the hype and have a view of there's just too many bulls in the room. We gotta bid, but we gotta bid accordingly. And stepping back from that hype, I think that's super tough to do. You're in the midst of a bigger structural bull trend that I described.
One of the ideas behind commodity investing is to invest in the low part of the cycle. Natural gas right now could be argued to be at the low end of the cycle. However, risk is what you don't see. How do you protect yourself against the risk that we're not at the low end of the natural gas cycle and you'll have to wait for years?
Well, there are different ways you can protect yourself as an entity and as an investor. Is there one you want me to focus on?
Maybe company specific. Without naming names, how would you look at strengths and weaknesses of what companies would you lean into?
Yeah, look, like for natural gas, so if you start at the 30,000 foot level, you can find various forecasts that say that North American natural gas demand is going to go up 25 to 40 BCF through 3035. And I generally make fun of forecasts that end in round numbers and fives, but there's clearly, you've got LNG demand, you've got AI, you've got all sorts of other things. That's on the one hand. The other hand is terrifying because there is lots of natural gas in Western Canada and there's lots of natural gas in the United States. There's no shortage of resource. And so there are things to manage risk within an entity. You can protect your capital program through hedging. When it's opportune, you can work on the tactics of strategy. You can work on owning your infrastructure and things like that to make sure your costs are down. And of course, the balance sheet really does matter as well. And the other thing that you really want to think about too, and Dave touched on this, is the strategic component of M&A, because there's always a panic for inventory, however much we think there isn't. I just said there's lots of natural gas, but for a given entity, sometimes it's more strategic or more cost effective to buy your barrels or your MCF on Bay Street than it is to buy them or to drill for it in the ground, right? Like, where are you getting your F&D costs and how are you setting those? And that can create great return on capital, particularly if you take advantage of it in a low part of the cycle. I mean, Q3 AECO was 69 cents, I think, which is, a 20-year low, something like that. And so, to Dave's point, some of the folks in town have gotten pretty aggressive, and, there's nothing wrong with making bets like that. They don't always work, but it's far better than buying at a 5-year high.
One strategy has been to sell into the States through various marketing contracts. How big of an opportunity do you see that for Canadian producers to take advantage of arbitrage pricing in the States?
I mean, let me just say a couple things. Steve made the comment, there's lots of gas. There is lots of gas, but not at any price. And again, let's just talk about how the energy sector looked in 2014. In 2014, when I looked at the energy sector, companies everywhere, no discipline, ramp, grow, management teams incented by growing, private equity roaring up to Canada. All these private equity guys are in boardrooms with your companies going like, this is where you should drill your wells. So the smart New York guys are the smart guys now? No, you guys are the smart guys. So this is what happens late cycle. You fast forward to today, the backdrop looks a hell of a lot different. When I look at the backdrop today, I've watched the biggest M&A cycle play out in my career. There's a lot of M&A going on. And when you look at the energy sector today, Chevron buying Hess, Exxon buying Pioneer. To answer your gas question, Trevor, Chesapeake mergers with Southwestern. Well, these are massive transactions happening. Tourmaline's done 6 deals in Northeast BC, right? You look at Tourmaline, CNRL, Ovintiv, they own 65% of the gas in Northeast BC, 3 parties. Look at the Marcellus. Marcellus was hundreds of companies. Now, the top 5 Marcellus producers own 75% of the gas. Chesapeake, Southwestern, these guys come together, they own 25% of the gas in the Haynesville. This play that's going to have all this growth, one guy owns 25%. So bigger and bigger companies are forming. And when you have oligopolies and bigger companies forming and the prices go up, they don't react like 2014 where everyone goes, oh my God, the price just went up, let's go. No, their capital programs go up marginally. There's an inelastic response to higher prices. So yes, there's a lot of gas, but not at any price. And I think the market is underestimating the reaction to price on gas, on oil, on the commodities. But I think it's a big deal, this big backdrop we're seeing for this setup for the sector. And I think on the gas side, it's super positive, right? I don't think there's going to be all these guys that just go blow their brains out at any price, which I think that in a mixer is going to add to volatility. I think there's going to be not the same reactions as people think, which is going to cause asymmetric upside moves to the commodity that you really want to grab. You don't want to be hedged up. You actually want to grab those asymmetric upside moves, make a lot of money, hunker down, get all the cash, and prepare for low gas prices again, because to Steve's point, there's too much gas. But through that whole period, who wins? The low-cost producer. The big low-cost producer with a marketing division that sells to 16 different markets. The big boy with massive credit ratings that can get and borrow and do LNG contracts. That guy has a big edge versus the junior Alberta gas company that sells their gas at AECO. And so in the theme of decarbonization that I described, the capital is going to go to the big boy first. It may eventually change and trickle down, but we got to see the multiples expand for these bigger guys with the really good quality businesses with 75 years of inventory before you start going down to these other things.
I think too, like and Dave and I have talked about this over the years, is the volatility. U.S. storage by memory has barely increased over the last decade. Maybe it's a couple percent, whereas, U.S. gas supply has gone up 30. So then you are, of course, going to see far more volatility. And you know what? As investors, renters, And as companies, we can take advantage of those components of the cycle, either on investing capital as an entity, as a stock trader, and for hedging as well. So there's lots of ways to mitigate and take advantage of the volatility.
This podcast episode is sponsored by Canoe Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Canoe Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is brought to you by pipelineonline.ca. Pipeline Online is Saskatchewan's energy news, providing comprehensive coverage on oil and gas, power production including coal, natural gas, geothermal, wind, solar, and nuclear. Pipeline Online now also provides coverage on emerging lithium and helium plays. No other publication matches the quality of Saskatchewan energy coverage. Find it all at pipelineonline.ca. What's the junior natural gas producer without access to the U.S. market supposed to do?
We've kind of said a lot, but I think like if I was giving a Canoe presentation to everyone in the crowd, a lot of people think we're in this commodity super cycle. We don't think we're in a commodity super cycle. We think we're in a commodity cycle that's going to take 10 to 15 years to play out. But we actually believe when you think through what's different this cycle, like I said, decarbonization. This theme is not going away. This theme is not going away. And in fact, it's going to be around for multiple years. With that backdrop, investors are second guessing, companies are second guessing, are you sure we're going to need oil in 2028? Are you sure that this capital is going to come back? I don't know, man. I think we're going to be on EVs by 2027. There's going to be this constant, are you sure we're going to need it? And that is good for profits. When you have this second guess nature, we think that alongside those bigger and bigger companies forming that I described, which is really good for the sector's profitability, as these companies are just handing back money to investors and not growing and ramping like they used to. When we put all this in a mixer, we think we're in an energy profitability super cycle where we just look back 3, 4, 5, 6, 7 years from now, and you look back and you've made a lot of money and got a lot of dividends and a lot of buybacks. And then eventually other sectors quit working, the money rotates into energy, and it's fashionable to be an energy investor again. That's our playbook. But you asked about the junior gas guy. Because of that reluctancy and hesitancy and lack of capital coming back and lack of private equity and all these things in a mixer, their access to capital is a lot harder. So just because you're small doesn't mean you're bad. People mix up that if you get bigger, you're better. Wrong answer, right? That's not true. But if you have a mediocre play and you're the junior gas co selling your gas at AECO, I think you're in a very tough spot. I think you're going to have a very poor cost of capital for a long time. But if you have an asset, to Steve's point, that someone else is going to want to own one day, you will get valued. Or these multiples that are starting to expand that I described, you just won't be around. Look at Crew. Right? Look at what's happening on the mergers and acquisition side. If you got the right rock, you're either going to re-rate or you won't be around. And Steve gets to see this from a board perspective all the time, where being that low cost guy and being in the right plays at the right prices and right point of entries, this is all super important when you're managing companies or portfolios like I am.
The energy index is flat year to date. So if you were to give advice to the investor on differentiating their stock selection, would you say lean into quality geology, excellent management teams, and good balance sheets, perhaps?
You know what? I'm going to jump in here for 1 sec on that, just in the sense that just think of the macro for a moment, and there's no energy managers left in Canada really to speak of. Like, I think there's two. One of them is sitting here in front of you. And one of the advantages that Dave has that's quite stark, frankly, is, and by the way, like, I've watched Dave grow in his career. It's been a total privilege to watch him grow up. It's been awesome. He's really good at what he does. And there's inefficiencies in the stock market today in energy that didn't used to be there, particularly in Canada, because there's negative funds flow and there's nobody, the generalist crowd tends just not to put in the work that is required to figure out what stocks to own. And so I really think that observing what this guy is saying today on how to pick these stocks and do these things, it matters enormously. He's kind of I don't even know if it's an oligopoly. It's almost a monopoly that he's got, almost. And it's very beneficial. So you think about things from that.
So I'll just pipe in there too. It's not just me. It's me and my team. Canoe has
Fair.
I mean, we got a rock star portfolio manager with Rob Taylor. I got the best trader in the country with Nick Sokol. I got Courtney McKean, who's the rock star that holds our group together. So there isn't just David Szybunka. There is a really good team to tout that or help me there too. So
spoken like a good leader, Dave. And I'm just illustrating though, like the opportunity to find interesting things in energy really does exist. Energy index is flat, but there are ways to create money. And Dave told you about being underweight oil. And we, Dave and I had dinner back in whatever it was, it's somewhere in the middle of summer, and oil was $80. And he said, I'm underweight oil here. And sure enough, a lot of these stocks corrected 30, 40%. Well, you know what? There's value to be found that way for people who are investing. It's hard though, right? Like you guys have day jobs, you got kids, you're taking everyone my daughter plays ringette. I think there's a lot of ringette dads here, but it's very hard to do this stuff actively and properly, right? And so there's simple ways to do it. Own an index. You can invest with Dave. You can pick stocks on your own, but it is time intensive and you guys have other things to do with your lives, right? I suspect, right? So anyway.
For those listening, Dave, what would you suggest as important things to look at when you're looking at energy stock selection?
So we started from the big picture, and that's energy consumption keeps going up. But when you look at the Canoe funds, we invest in subsectors, right? We invest in oil and gas and alternative energy and refining and LNG, and we look at services, infrastructure, we look at it all. So these things never go all up or all down together. They're always working for and against each other. If all of a sudden you guys are drilling a bunch of wells and the commodity prices are going higher, these service guys are grinding you. Well, that's good. The service guy's bad. The producer. All of a sudden we overbuild pipelines. All of a sudden there's too much pipeline capacity in certain areas. Well, guys are lowering tolls. That's negative. The infrastructure guy, good. The producer. So these things are always going back and forth against each other. We've done a good job at the firm going we are just a pie allocator. What percentage of the fund should be in this subsector? And the more we get confident, the more chips we put in. And sometimes we're balanced and sometimes we're overweight this and underweight that, but that is how we manage the capital. That's been a good thought process for investors to have within energy versus just being a oil bull. That hasn't been a good thought process when you look at that. So the subsectors matter and the companies matter. I've already described the cycles and where we're at and how this all goes, but generalist capital in 2021, what was happening in the market? For the first time in a while, other sectors are blowing up. Inflation hasn't hit for how long? Inflation's happening. It's ripping. The interest rates are going up. The macro backdrop's changing. We could feel money leaving other sectors. I remember selling this one stock and I'm just going to my trader. I'm just sell 500 to this guy. He's going to buy this thing off us. Sells us 500. Then all of a sudden it goes up another 50 cents. I'm sell him $1 million. Then it goes up another $1. I'm sell him another $1 million. And I watched that guy reload with another 5 million shares to buy, another 5 million shares to buy the next day. That's called sector rotation. I have not seen that in 2 years. Why? Because inflation peaked at 9%. It's been going down. Everyone's whew, thank God this is over. That's the mindset. And I don't know, if you talk to Rob Taylor, a CIO, he's one of the smartest portfolio managers I've ever met. He's the inflation comes and goes in waves. It never just comes once. It comes back over multiple times. There's structural changes beneath the surface that are happening. There's these things happening beneath the surface that I'm telling you, if a second wave of inflation comes back, the market's going to be a little rocky. It was the second wave of inflation in the 70s that the market got crushed, not the first. So what have we been missing as energy investors the last 18 to 24 months? Money coming in. In fact, it's been going out. You guys are all reading headlines going 60-something dollar oil. And the generalist portfolio manager's well, this didn't work. Well, in fact, it did. Our funds are up 20-some% on the year. Our funds were up in 21, 22, 23, 24. It's working. You just don't feel like it's working because you're looking at the headlines of $60-some oil. But If other sectors quit working, S&P, tech, all these other areas, there's so much money in these other areas, money will come back to energy. And when the money comes back to energy, we're all going to feel smart again. So we're just trying to work our way through this digestive phase, but being in the right stocks and places where we're seeing multiple expansion happen in certain companies is really important. You don't want to be starting from down 40. And if you've owned the wrong stocks the last kind of 3, 4, 5, 6 months, you're down 40. So getting through the digestive phase as everyone's giving up and going, okay, this didn't work, this will inflect the other way. And then everyone will feel smart again. But in the meantime, trying to work through that is always tough.
So Dave, is the, like, I'm seeing a bit of change in funds flow on, the AI driven independent power producers and natural gas producers. So am I guessing right that funds flow is starting to come in? Are you seeing that or not so much yet?
That's a good question. So I've said to our investors over the last 6, 7, 8 months, separate the commodity in natural gas from the stocks in natural gas. When I was doing presentations 2 years ago, peak ESG, all you guys are doing ESG reports for your companies. It's just like, hydrocarbons are dead, man. Get out of here. You're in a dying sector. Well, that wasn't true. But they were trading the sector like it was a blowdown sector, like we weren't going to need it. You fast forward to today, and a lot of people have a hard time separating the commodity from the stocks. Because as we all know in this room, the commodity the last 6, 12 months on gas has been pretty bad. We had the lowest natural gas price in the last 30 years, year to date, on gas. But look at the gas stocks. The gas stocks are up. Look at our U.S. gas equities the last 3 months. They're up 30%. Why? It's a version of what Steve's just said. The narrative was already shifting over the last 12 months on, well, of course we should get off coal and start using gas. If we're using all this alternative energy, intermittent power, up, down, no wind, solar, you're going to need more baseload, natural gas. So the market was already starting to be like, I think we're going to need natural gas. And then in the last 6, 8 months here, we've poured gasoline on the fire with this whole AI energy demand theme. I know everyone's getting jacked up on nuclear, and I'm not saying you don't need nuclear, but it's a 2030 plus thematic. It takes a long time to build this out. So the solution is gas. We're going to need a heck of a lot of natural gas. And that's where investors have been like, yeah, but AECO's 20 cents. Who's buying gas stocks at 20 cent AECO? And I, as a portfolio manager, have been like, buy them, keep buying them. There's a narrative shift and the train is leaving the station. And you can feel it. Like when I go to conferences, we go to Goldman Sachs conference every January. When we go to that conference and you're standing in the refining integrated oil panels, they're a third full. When you go the last 2 years to the natural gas panels, standing room only. All the generalists are there. They care, but they don't want to buy it because it's energy. And other sectors are working, but the narrative shift is there. And I feel like this sets the stage for multiple expansion for the group. But again, this is not a just go buy a bunch of gas stocks. This is buy the right gas stocks. And if you've had the right gas stocks on the year, it's been pretty darn good.
Steve?
Yeah, well, I got another question for Dave.
What?
I mean, I kind of know the answer a little, but I'd like to hear his thoughts. But just in the sense of in the realm of owning something someone else wants to own, long duration gas does come to mind. And, I also take that into context with the weak Canadian dollar and say that at some point, I don't know how or when, but at some point we're probably going to have an M&A cycle in Canada with U.S. producers coming to town. I mean, Ovintiv is semi-Canadian is how I would view it, given its heritage, but which occurred last week, which you all know about. But, it's some phrasing for you also to think about, I suppose.
I mean, you kind of bring up that point, but I think I get asked all the time by investors, Justin Trudeau out, Poilievre in. Is everyone going to start buying energy again? Our funds are up 80% in the last 3 years. Oil's down, gas is down, and Trudeau's still in power. If you're waiting for one big thing to make this an investable sector, the train's leaving the station. Like I said, we're in year 4 of a 10 to 15 year cycle. It's never one big thing that happens. It's multiple things that happen over time. That's how this generally plays out. And I always say to our sales team, price drives sentiment. The higher they go, the more people buy them. And so you got to keep all that in mind. And I would just say, this has been happening before our eyes for a while now, right? Like when I look at, I'll give an example on just like last week. Trevor, you're saying like address the emission pollution cap. So last week, the Fed government comes out and says we're capping the energy sector on its pollution and emissions. I got 0 calls from sales guys. Not one person called me. Not one investor called me. If this was 2018, 19, 20, I would have had 20 calls from salespeople. My inbox would have been barred going, see, I knew it. Canadian energy is uninvestable. Get out. And all of a sudden this comes out and everyone's like, whatever. They're kind of looking through it. And you come out the next week, Suncor comes out. Is everyone going, hey, Suncor's the biggest emitter of CO2 in the oil sands. They're the most exposed to the federal announcement last week. No, they're talking about Suncor's quarter, how they blew it out of the water, raised the divvy, hit their debt target, 100% of free cash to shareholders. And I love Suncor. The stock closes up 4.5% on the day. The narrative shift is already happening. That's one example. I could give you 10. And the narrative shift is happening, but we're not recognizing it. Rob Taylor, our CIO, has a wicked quote. By the time things become fashionable to talk about and we're all around the water cooler going, are you overweight energy too? It's not a good time to be in energy. Trust me. When the headlines all in the news and CNBC are like, these energy stocks, they do it again. It's late stage. I'm telling you today, I don't think I've seen an energy company on CNBC in the last 2 weeks. No one wants to talk about it. It's about AI and all this other stuff. So that's a long-winded answer of just saying like the narrative shift is already happening, people. And we haven't recognized it because other sectors are still working. But energy is actually working too, if you're in the right areas.
This time next year, there will be a new U.S. president, most likely a new Canadian prime minister. How do you guys think about drill, baby, drill and tariffs? And do you worry that?
Yeah.
How do you think about that?
Sure. So, well, from a board perspective, let's just pretend we're all on the board of a U.S. company. What do you think about drill, baby, drill, right? And so you're capital allocators, you're making capital budget decisions with your management teams. And just because Donald Trump has decided that oil prices must go down, you're just going to risk a bunch of capital to help him do that. Doesn't make any sense at all. I don't think it changes any behavior of anyone. And, opening up the federal lands and the ANWR and things like that. So let's pretend a management team came to me and said, we want to put all this capital toward federal drilling in the U.S. My first question would be, how much capital are you exposing? What are the geologic risks? And what are you going to do 4 years from now when the administration might potentially change? Like, how much political risk are we taking? Because these political parties seem to flip-flop a fair bit. So the other thing is that's really changed in the last decade. 08 to 18 was the shale Ponzi scheme. Notionally $800 billion was spent with no free cash flow in the big 4 U.S. basins. Okay. That's my math, by the way. So it might be wrong, but it's directionally correct. And one of the things that U.S. investors demanded was change in incentives. So U.S. companies in particular, some Canadians used to get paid for production growth. Just absolute, doesn't matter how, it's just more barrels are better. And these have all shifted to things like return on capital and PDP recycle ratio and things like that. And you change people's incentives and guess what? Their behaviors change. And so I just don't see any impact coming out of that. What was the second part of the question?
Tariffs and drill, baby, drill.
Right. So the tariff side, there's a lot of people in the world who know a lot more about tariffs than me, but I would just observe that Trump 2.1 had a lot of noise on tariffs, but there were lots of deals done in the back and lots of exclusions. Sounds like, I'm guessing Trump 2.0 will be the same. And I'm guessing you're asking about if there's going to be a tariff on Canadian oil. There's no chance of that. The amount of oil that Canada exports to the U.S. and there's all the refineries down south need the heavy crude. And I mean, you want to spark an inflationary cycle, you would put tariffs on Canadian energy. I think that's a non-starter.
And Steve, let me maybe ask you this question. And again, like you're on the board of a bunch of different companies. Like, let's just play out the last 24 months. There was a period there, Russia-Ukraine war, commodity prices were spiking. And what's all the things that we were all seeing on TV? We were all seeing headlines of windfall taxes. Oh my God, they're going to windfall tax the sector. And I got asked about this every second presentation. And And my response was, if you want to create a bigger problem, then go ahead and windfall tax them. Like, that is going to create even less capital investment. And so now we shift fast forward to today. There's still lots of dividends, buybacks, shareholder returns the focus. When I go to conference, very few conversations are like, what project are we going to expand here? Let's talk to investors about that. No, it's about dividends and buybacks. That's the theme, which tells you where we are in the cycle. As we shift, where investors are like, why are you buying back your stock, man? It's so high. There's a third war breaking out here. It will shift to, you should be spending more. Show me your projects. Bring out the maps again. That's how it will shift. So today, as we've seen Trump get in, you see Chris Wright come in on the energy side. This guy's a very pragmatic energy person. He gets it. My question to you would be, how do you think the sector will react if it's actually the opposite of what's been happening, which is, let's lower royalty rates. Let's create incentives for the industry to drill. At a time that I've watched the last 2-3 years, management teams changed incentives to actually hand back more money. The more money they hand back, the more money management and board make. They're not incented to grow. But if all of a sudden we saw a shift in policy that drove the rates of returns, if you will, higher, how do you think that playbook plays out? I'm curious your thoughts on that.
Yeah, I don't know that I know the answer, but if regulations go away or become less so and royalty rates drop, I mean, you could certainly see companies become somewhat more active. I think that that's pretty fair. But at the same time, if everyone goes whole hog, all you do is lift your service costs and all the economic rent leaves the system anyway. And because of the incentives and return on capital, I think those moves would be much more measured than a whole hog, let's get after drilling really hard and fast here. Like, I don't see that changing to the same extent as it would have a decade ago. Decade ago, everyone would have gone hell bent for leather, right? So
yeah, because a decade ago, as we all know in this room, in year 4 of a 10 to 15 year cycle, Calgary's back, baby. Let's go. Barcelona, come on, light it up. Let's go. That's what Calgary was literally 2004, 2005. It's different. These companies are structurally spending 60% of cash flow, 50% of cash flow. And right when you get these commodity checkbacks, you don't get as many shareholder returns as you think from some of these companies because their assets can't support it. But there's not this big structural shift or decline in capital spending on the back of a commodity checkback. But I think when you answer that question, it makes my head go, I think this cycle's longer. I think it's going to take longer to play out because there's not going to be this ramp up of capital when we eventually hit the crossroads of structural underinvestment.
Yeah, don't forget too, like, you say you're a given entity and we're going to add 10% to our capital program, how much that stresses the team out. It's hard. You've got to mobilize rigs and you've got to mobilize infrastructure and the geologists have to be picking locations, and you add a lot of capital and it can start to be spent very, very inefficiently, right? And that's the biggest problem with spreadsheet math in oil and gas, right? So I don't think it would go nuts.
Some investors view LNG as a panacea to the natural gas prices. How do you guys think about that in terms of classic supply and demand where it'll just repeat the same old highs and lows? Do you think LNG will make a big difference for natural gas producers in Western Canada?
I mean, I'll answer that a bit. Look, like when we just look at the backdrop, I think what Steve said was super important earlier. In the last decade, natural gas consumption is up 43%. In the last decade, natural gas storage is up 2%. So we're using more. Like, I remember I'm the young guy on the Peters Co desk, and there'd always be these weekly natural gas storage bets, right? We'd always do these bets. In hindsight, when you're calling out the traders and you're the young guy, it's like, why am I calling out a 15-year trader on the Peters Co desk? But anyways, you'd just be like over under X BCF a day withdrawal or for the week. 180. That was a crazy number that you took out of storage on the week, 180 BCF. Well, now some of these cold weeks are like, you take 400 Bs out of storage in a week. So we are setting up where we keep filling the brim of the glass to the same place, but we keep using more. And all of a sudden, if we did get a cold winter, which we haven't had for 3 years, you could physically draw a lot of gas out of storage really quick. What else is happening? Well, in the US, We've gone from having 3-4 BCF a day of exports to 13 BCF a day of exports. And in the next 2 years, it's 25, 26 BCF a day of exports. We're actually sending more of this gas to the rest of the globe. You can just start to envision how as the globe is more integrated, as you're sending exports and the U.S. is being the nice people sharing cheap gas with Europe and all this stuff, we are setting up for volatility, asymmetric upside moves. It's cold in Europe and Europe starts pulling and all of a sudden North America's cold. I think gas could go higher than people understand. And into that, it will stay high for a while and then it will eventually end because there's a lot of gas. But I think it's going to become more integrated, to answer your question, across the globe. And what I would say too is you talked about that Jevons paradox concept of as the price goes lower, we just use more. Well, what's the rest of the globe had for the last 20 years? Gas has been $15, $20. Global gas has been $10 to $20 for the last 20 years. Well, we're about to have all this global LNG built out that sets that price lower. We're going to make the new price 5 to 10. Well, maybe industrial activity does come back to Europe. It's done nothing but leave for the last 2-3 years. So this is the stuff that will spur more demand over time. I'm talking in years, not quarters. We will back up LNG. I mean, I also said what ends a commodity cycle is a capital spending cycle. Well, what ends an LNG cycle is a capital spending cycle. What are we seeing right now? Every country across the globe coming out of Russia-Ukraine war is like, off Russia gas. Let's invest in LNG. So now everyone's investing in it. We are overcapitalizing it right now, but this will create a lower global price, which will create more demand that will add even more energy into the mixer that we've all talked about already, right? So it will come full circle.
Yeah, I think a real simple man comment would be AECO price is probably the lowest cost molecule of energy on Earth. So I don't know why I'd be short it necessarily.
Do you think it's possible to build LNG in Western Canada? Will the federal government change help? Or is it a pie in the sky?
Well, I don't like to talk out of school too much in the sense of back in my Peters Co days, I traded billions of dollars of stock on the thought that LNG was going to come to Canada and we're going to have our first one next year. It's so far behind and the U.S. has destroyed us. For 2 hockey teams, it's 25-0, right? Like it's incredible what those guys have done and full marks. And so I am somewhat bullish. I think the Shell project is real. There's a handful of other ones that are genuine at the margin and hopefully they get done as well. But Canada is pretty rough on entrepreneurs who are successful and puts things like regulations in the way. And, you know, if Poilievre wins the next election, hopefully he can find someone like a Chris Wright down in the U.S. from Liberty Energy. I don't know if you guys are familiar with his stuff, but you should go read the work on Liberty's website because it's excellent. And maybe we can work toward being more functional as a country. But as of today, the amount of regulation it's staggering on every industry. It's not just energy.
And the only thing I would add to that, like if I was sitting here going to you guys, I think Canada's energy policy hasn't been very good. Canada has been awful. It's 25-0 to Steve's point. How do you make money on stocks? Rate of change. What if it gets better? This is where I start to go as an investor, where I'm like, what have I watched the last 10, 15 years? Money's left to go to the US. Everyone's long the S&P. Everyone's negative the Canadian dollar. Everyone's like, we'll buy US energy, not Canada. As the valuations and the ARBs and stuff are happening and Avintiv's coming back to Canada. So what if Poilievre comes in and actually puts someone in its place that can actually understand policy, and all of a sudden Canada becomes a really good backdrop? The rate of change on that is massive because I've watched US investors just ignore Canada for a decade. They just play the US energy gas names. Why are they buying Canadian, Western Canadian gas? But when you look at the holdings on some of this stuff, I would say as you start to go down, Canoe's the only owner of some of these stocks. Well, what if there's a positive rate of change? I'm telling you, the next move will be they come back. That's how you make money. So I'm not predicting that, but I'm identifying there's not a bull Canada guy in the room. Everyone's bearish. So we need to change the policy to make that positive rate of change happen. But I think it's super notable to just go, Everyone's negative. There's things that could happen here in the next 12 to 24 months amidst commodities that have been going flat for the last 2, 3, 4 years. What if we leg up again? If historically the rule is, if you just play the commodity cycle, get long the country like Canada, play the commodities through Canada, Australia, that's where you want to have your capital. So I find if that actually played out, I could really envision in my head how the S&P is an ATM because it's been so good and valuations are so high that it actually draws money out of that market into these other areas. And Canada could be a really big beneficiary of that depending on our policies.
For those listening, the PDF is titled Bettering Human Lives, and it's available on the Liberty Energy website. For those that are listening online, you can find a great PDF on kind of a change in energy policy that seems to be occurring in the States with Chris's appointment and hopefully in Canada too. So
For sure.
that's an hour though. So I don't know if you guys want to go over any more topics, but we can maybe get into Q&A from anyone that is here. If there isn't any Q&A, we can more or less wrap up. So, okay, for the online version,
Okay.
Sentiment in the Duvernay, and maybe Dave can take that one.
Sure.
So I would just say this on the Duvernay, when I talk to industry, the rate of change in the last 2-3 years is definitely more positive. Costs down, rates up, figuring it out better, technology, longer wells. I'm hearing the right things that are driving the rates of return better. Pair that with an energy sector where money's literally been leaving for 18 to 24 months. So I feel like the industry's turning more positive on it at a time that the capital markets are just, the flow I've seen the last kind of 6 months has been sell this mid cap and just go buy Trap, Enbridge, Pembina, Suncor, CNQ. I'm done with this. Get me out. Which is interesting because then you come in last week and you see the Paramounts of the world sell Ovintiv 2/3 of their assets for almost the market cap of the company. And all of a sudden the stock's up 15%. So industry, if you're right on the rate of change and it actually proves to be the real deal, industry will figure this out way faster than my side of the street, right? My side of the street will react. 95% of investors react. They don't anticipate. We try and anticipate at our shop. But I find it interesting because people are still kind of negative, the Duvernay, I would say, from a capital markets angle. But industry's definitely turned more positive.
Okay, for the online listener, question on Keystone XL via the Trump administration.
Well, I got an answer for it a little bit, so I'll just be quick. To simplify it, what's our big picture belief? Energy for the last 20, 30 years, the globe has had cheap energy, and it's been everyone holding hands, singing Kumbaya, getting along. And we think the world's changed. We think the world's dividing. We think we're seeing places with lots of people team up with places with lots of resource. We think the world's dividing. And with that is going to cause elevated geopolitical risk and elevated costs for consumers as it relates to commodities. When you put all of that in a mixer, we're not going to be talking about ESG and all this stuff. We're going to be talking about energy security. And in the world of energy security, Canada has a hell of a good resource hub here that the U.S. guys need our heavy oil. The U.S. refiners need our heavy oil. These refiners were built 70 plus years ago. There's more renewable diesel and all that stuff happening, but they still need a hell of a lot of heavy. Well, we've watched Mexico pare back their heavy because they brought it in-house. We've watched crude decline in Venezuela and these types of countries. So the Canadian heavy barrel is really valuable. And I think if you, all of a sudden we're going to go from a version of, and I've said this to a lot of our investors before, Republicans versus Democrats, liberals versus conservatives. It actually swings to us versus the Soviets, us versus China. We all get along to go, they're the bad guy. And then Keystone gets built as Poilievre and Trump are in power. Like some version of what I'm saying is not unimaginable. I just think these cycles take a long time, and 3 years ago, everyone's saying oil's over. Where's the windmills and solar panels? We're shifting, but it just takes time to play out over time.
Yeah, I'd take a different stance on that, just from the perspective that Keystone last time was stopped with a stroke of a presidential pen. And I worry that the flip-flopping of administrations every 4 years is not, and one of the questions I think you would ask before attempting this again is to say, well, how much capital and time are we going to risk, and can we get it done before the next election. And those are real risks because you can't go run around putting more, billions more into the ground and then never getting a return on it. So I'd be a little more skeptical. I'm hopeful, but I'm skeptical.
So risk my comment to 2032. Because I agree with Steve. You're not going to see people spend billions of dollars on a maybe, right? It's got to be we are supporting this, we need this. And the other thing I would say is just, it's a very investable theme within our funds is there's a lot of red tape on pipelines, on like building out the grid. When you just look at the grid, we didn't really touch on energy AI and all these things that are happening. And we're all just acting like you snap your fingers and then you get all this electricity. The grid is on average 40 to 50 years old in the US. The transmission across the US is 600,000 miles. Well, on average, 5, 6, 7, 8 years ago, we were building 5,000 miles a year. Well, last year we built 600 miles. It is so hard to push this through. There's going to be these pinch points that happen that, again, bringing that back to gas a little bit, you might have a weak gas price, but maybe there's select hubs that spike because there's just too much demand within those select hubs.
Yeah, there's a duration mismatch, and we're diving into AI now, but you think about the duration mismatch. It takes about a year to build a data center, and it takes 4 to 5 years to build a gas-fired combined cycle power plant, and it takes 10 years to build nuclear, roughly. So there's a complete, if you just had a data center and show up and say, I need power, like, where do you plan on getting that from? Those are real, genuine timing mismatches.
But then to push that agenda a little more, we are in a tech AI arms race. And if you think these big tech guys are going to sit around and wait for the grid to get built out, you're wrong. They're going to source the power and they're going to use any avenue to get that. Yes, all the nuclear and Brookfield announcements on renewable energy, they're all fashionable, but we know that there's a bunch of gas deals happening in the background. And I just think it comes back to we need it all. And these tech companies know that. But this is very interesting as we bring this back to markets because the tech guys are pushing forward. They're sourcing the power. Who's going to be affected by that? The consumer, the lower middle class Americans, at a time that 43% of the S&P is under SEC review right now. Well, maybe this impacts markets and rotation and capital. This is the stuff that we think about that could actually start to drive that rotation that we talked about. A good quote that we say is, it doesn't mean that technology needs to fail, but maybe energy needs to win first. They're going to be the ones supplying the power for big tech. I don't know how we got on big tech.
I don't know.
After Keystone
We're
question.
both halfway done our first beer. So.
All right. I don't know if there's any other questions from the crowd, but if not, then there's a couple from Twitter that I have to ask, or else the Twitter audience, X audience won't be happy. So maybe the first one might be best for Steve, and it's from DPB via X on the royalty markets in Western Canada. The theme seems to be winning, but do you worry that it's becoming over-competitive?
Well, look, there's I say only, but there are 3 royalty companies in Canada of any real size. There's a number of smaller ones, and I think all of them follow a different strategy, and competition is healthy. And I think having your strategy in your square is healthy. And the amount of transactions that Topaz would review is quite substantial, but it's also even, it's just as substantial how many aren't undertaken. And I think that just ties to execution of strategy and capital discipline and being thoughtful about how you proceed your business. So I don't think that it's all that bad, to be honest. Like it's always competitive, but it's not so much that you can't undertake curious and interesting things. Is that fair?
Absolutely. Dave?
I mean, we love the royalty businesses, and a lot of times we're just too close to the Topaz and the Prairie Skies. Like when you actually broaden out your scope, some of the best performing areas of energy on the year are royalties. Go look south of the border. These U.S. royalty companies are on wheels. This one company, I'll bring up Texas Pacific Land, like this thing has seen its market cap go bonkers on the year. This company's market cap is 31 billion. This is a 31 billion market cap that generates 500 million of EBITDA. And then there's companies like Prairie Sky that are 500 million of EBITDA with a 7 billion market cap. There's massive arbs. Topaz is even below that. So Topaz is at 13 times, Prairie Sky is at 17 times, and Texas Pacific Land is at 30. Well, this is the stuff that people go like, shouldn't M&A happen here? So, and the other thing I would say is go broaden your scope out to the gold sector, right? Go look at some really good companies in Franco-Nevada, Wheaton Precious Metals. These guys have wicked cost of capital. So I feel like coming out of bear markets, the sell side will just look at, well, this used to trade at 13 times and now it's 15 times. Well, if you expand the chart a little bit and go look at where some of these really good quality businesses trade and where some of the other quality businesses in the market currently trade, they're still really big ARBs.
Room for growth in Canada. Hopefully.
Yep.
Well, that's a lot of questions. I think that's pretty good. It's an hour and 15 minutes. So just want to say thank you guys again for your time. Steve and Dave, we really appreciate it.
Thanks, guys.
Okay, thanks for having us.
And, Also, thank you to Mandy and Dave once again for organizing this. Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.